Hi everybody, this is Colin Murphy and welcome to Torcana Podcast number 24. So for the first time in 8 episodes or so, I've decided to do another solo show. So hopefully you'll find it interesting because the topic I've chosen is pretty huge. So in today's podcast, I'm going to discuss the decline in home ownership in the United States, the key factors that are driving this trend, and why it is good news for investors. So owning a home, owning a piece of America, that was always something people strived for historically. But that's been changing. That's been changing a lot over the last 10 or 12 years. So back in 2004, home ownership peaked at a rate of about 70%. Okay? And today, the rate of home ownership in the US is less than 64%. So while a 6% drop mightn't seem too substantial, we're talking about millions of households. But more importantly, even though we're adding new households all the time, because obviously the population has increased a lot since 2004, the new demand is being satiated by rentership. So of the 14 million new households added in the past 10 years, guess how many of them are renters? 80%. That's a massive shift hidden behind the drop from 70% to 64% home ownership. So what are the factors driving this trend to renting versus owning? I've come up with 4, okay? They are tight credit markets, high student debt, affordability of housing, and low personal savings rates. So I'm going to go into them in a little bit of detail, and then I'm going to talk for a while after that about why these trends can be very good news for investors. So starting with tight credit markets. So as a result of the recession back in 8, 9, and 10, and the country over leveraging itself, the credit markets have tightened, and that made it very difficult for people to get a mortgage. This is the fallout of the Great Recession. I mean, lots of people, mostly bankers, mostly builders, got really greedy, and nobody wants to go through what they caused again. Nobody wants to take on that so much pain. So it's much more difficult to obtain a mortgage now, and I don't see that getting better anytime soon. So put simply, you need a much better credit score than you used to qualify for a mortgage. Do you know what the average credit score for borrowers these days is? It's 739. If you're not familiar with credit scores, that is very high. And with a threshold that high, large numbers of regular people that would have qualified in almost any other time in the last 30 years aren't qualifying for mortgages anymore. And when you add to the fact that millions of people's credit scores took a big hit during the crisis, the kind of gap between those who can borrow and those who can't borrow is just getting bigger and bigger. So the borrowing pool has shrunk, and that means more renters. If less people are going to qualify for mortgages to be homeowners, that means there's going to be more renters. So can we envisage a situation where these millions of these people can improve their credit scores and qualify for the loans that they're not qualifying for now? Absolutely. It's quite possible. It's quite likely that their credit scores will improve if the general economy keeps improving. The US is pretty strong right now. We're getting good economic growth. We're getting good wage and job growth. It's tipping along quite nicely. However, when that happens, usually leads to inflation. And to counter inflation, we increase interest rates. Okay, so now you'll have a market where people's credit scores might improve, but their cost of borrowing is just going to get higher. And when you add to that, house prices have been going up as well, so affordability is getting higher. So if people do manage to improve their credit scores due to a general rising tide, there's usually some side effects like higher borrowing costs that are going to take away a lot of those advantages. So number 2 in this list, which is actually a big elephant in the room for the US economy, and I think we're going to see a lot more people talking about it in the next year, is that there's been exploding student debt. So in the last 10 years, the total student debt in the US has almost tripled from $480 billion to $1.4 trillion. Obviously, needless to say, the population hasn't increased threefold in that time, and there certainly aren't 3 times as many students now compared to 2007. So the vast majority of this increase from 480 billion to 1.4 trillion is simply down to universities charging higher fees and students needing more money to pay their way through college. So while housing debt is $1 trillion below its previous peak, the increase in student debt and car loan debt has more than made up for that. So you could almost argue that we've swapped a housing bubble for a student debt bubble. Okay, I'm serious about that. So in America, there's 44 million people with student debt, and the average debt is $34,000. Okay, compare that with what students were borrowing 20 or 15 or even 10 years ago. It's like night and day. And that 34,000 debt is real money that can and will severely restrict a person's ability to save for a deposit and buy a house. Okay? So while there's some valid reasons for people in their 40s and 50s to give out about the attitudes and the laziness and the entitlement of the millennials, the fact is that these younger people are saddled with debt that older people just never had to deal with. So number 3 on my list, and they're all kind of linked together, is affordability. So affordability of housing across the country, that's the third factor, and the third thing that's pushing people towards rentership. So we're all aware that prices have been appreciating a lot in most metro areas, really going back to 2011. So in Tampa, Florida, where I'm an active real estate investor, median sales prices increased by 14.4% between December 2015 and December 2016. That's a big increase, which is great news for landlords who like to see their assets appreciating, but not so great for people that are trying to get on the ladder in the first place. And so with house prices increasing all the time, people need bigger deposits and they need to qualify for bigger loans. Again, that restricts the pool of buyers, increases the pool of renters, and increases the rents that landlords can charge. The fourth factor is low personal savings rates. So this is again strongly linked to student debt, and rising house prices are the savings rates. So put simply, if people aren't saving for deposits, they're not going to be able to afford a house. So I'm 37 years old, and back when I was 19 or 20, my generation certainly didn't spend anywhere near as much as today's 20-year-olds on gadgets, on holidays, on cars, leisure activities, and obviously if you go back 40 years, even different again. So nowadays people are saving 5 or 6% of their personal income, which is higher than it was during the boom, but it's creeping back down again. And in fairness, not all of it is because people are buying new iPhones every year or new laptops every year or going on foreign holidays every year. A lot of this is down to people living pretty sensibly, but they just don't have enough left over to save after they've paid their rent and after they've serviced their student and car loans. So house prices, rents, and student debt are all increasing by double digits every year, while wages are either steady or rising at a much slower rate. So in practical terms, that might mean that 30% of your income is spent renting a house this year, but next year might be 35% of your income. So you don't really need to be an economist, you don't need to be Paul Krugman to figure out that this combination makes it very difficult for an average person to save for a deposit and qualify for a loan. Okay, so it might sound like I'm painting a pretty bleak picture here, but I'm actually not trying to, because A, I believe the current environment is excellent for property investors, and B, I think we have an important role to play by renting stable, long-term properties to people that deserve them. So America is a little bit obsessed with home ownership. I mean, they're not on their own. Ireland is a little bit obsessed with home ownership as well, but there's really no need to be. A high percentage of owner-occupiers doesn't mean a country is healthy. I mean, look at Germany. Economically, it's right up there with the most powerful countries in the world. Well, if you're worried about home ownership in the US falling from 70 to 64%, consider that the home ownership rate in Germany is 52%. And people are perfectly happy with that, and the country's doing just fine. In Switzerland, one of the richest countries in the world, is just 44%. So, when I was a kid in Ireland, there was a little bit of a stigma attached to renting. If your friend's parents were renters, kind of meant that they were poor and didn't have great jobs. But there's been a shift in attitude since then, particularly among younger people. So what I'm trying to say is that you can be a successful professional with a great family and a happy long-term renter all at the same time. I know loads of people with good jobs that are renters, and I'm sure most of our listeners do too. So I think investors have this huge opportunity as America continues this shift away from home ownership and towards renting. I don't think convincing more Americans to buy their homes is necessarily a good idea. It doesn't really solve anything, and it just isn't for everybody. But I do think investors have a role to play by providing great rental properties to people that want a safe place to live. And in exchange for doing that, they build equity in these assets and they earn passive income streams to fund their lifestyles and retirements. It sounds like a pretty good deal to me, right? So at the most basic level, we'll just get back to basics, everybody needs somewhere to live. If you remember Maslow's hierarchy of needs from your business or your economics class, shelter was right there on the first level beside food and water, okay? And so as more people are turning to renting, you can be the supplier of inventory. And best of all, it's a win-win situation. Because at the minute, the US economy is pretty strong, and yet we still have huge numbers of renters due to the tight credit markets, the rising student debt, and the housing affordability that I was talking about a few minutes ago. So what do you think will happen if the economy gets worse? Do you think there'll be less people renting and more people buying houses if there's a recession? No way. If the economy's in trouble, people are just going to start downsizing and or renting cheaper houses. So if you want my recommendation on what to invest in, it would be the properties that can be rented or bought by lower middle class families and younger renters. You don't want to be renting a big house for $4,000 a month to a software engineer because he's going to move somewhere else if the market turns. For my money, it's better to have something that will always be affordable. So I'm talking about nice houses that cost between $100,000 to $150,000 and will rent for $1,000 to $1,400 a month. They're the kind of Goldilocks properties that aren't so expensive that people will stop renting them in a crisis, but they aren't so cheap either that you'd be stuck with problem tenants all the time. So there's loads of places in the Tampa metropolitan area that meet that criteria, and those are the properties that I add to my portfolio, and those are the properties that myself and my colleagues renovate and sell to investors every week as well. Okay, so I could keep talking about this all day long, but I think we covered a good bit of ground there, and I'm going to wind down the show a little bit shorter than usual. But if you can take one thing away from this podcast, is that the pool of renters in America is going to continue growing no matter what happens in the general economy. And you can make a lot of money by finding the right kinds of homes for them. All right, so I hope you found this useful. Your feedback is always very welcome. Any ideas you have for the show, any guests you think I should be talking to, please let me know. You can just log on to Torcana.com. That's my website, Torcana.com. You'll find ways to contact me there. And thanks again for listening. Please do leave us a comment or a rating on iTunes or the Play Store. That helps a lot. And I'll try and come back soon with a new podcast and a new guest. But in the meantime, this is Colin Murphy from Torcana signing out. Thanks for listening and have a great day. This recording contains general information relating to the real estate market and it is for educational purposes only. Buyers should always seek appropriate legal, tax and financial advice from suitably qualified professionals before entering into any real estate transaction. Actual returns from rental properties will always vary from person to person and deal to deal based on unique circumstances. While we have no reason to doubt the validity of comments of any guests on our show, we do not warrant their accuracy. Opinions of the host are not necessarily shared by other employees and partners of Torcana and its subsidiaries.